Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com. Our summer series has come and gone. It's past Labor Day and time to get back to school for many investors and for you folks at home revisiting our portfolios. So I'd like to introduce on the show today someone that can help us get ready, refocused. Please welcome Michael Gentile to StansberryInvestor.com. He is an institutional money manager for the past 17 years. He's a strategic investor in the mining sector and recently co-founded an investment firm in Montreal. Michael, welcome. Nice to meet you and welcome to our show here.
Thanks, Nia. Pleasure to be here.
So as I said, it's really a back to school, a refocus. Are you sensing that as well? Past Labor Day, it's time to revisit the last half of the year here and how we should be positioning ourselves?
Absolutely. We're through the summer doldrums, so to speak, and I saw more press releases in my inbox this morning than I saw in the last 4 weeks combined. So a lot of companies starting to put news back out in the market. Portfolio managers are getting ready, trying to position their portfolios like I used to do, institutional money manager for the last 3 months of this year, but more importantly for the calendar 2022. So wanting to see how their portfolio should look like starting next year.
So perfect. That's what I want to talk to you about today, of what we can expect, like I said, for the remainder of the year and as we start up 2022. On that note, Goldman Sachs coming out downgrading its economic outlook over the weekend, citing the Delta variant and fading fiscal stimulus as a concern. Also, Morgan Stanley downgrading U.S. equities to underweight. They said we see a bumpy September, October as the final stages of a mid-cycle transition play out. Now, I know you've been calling for a stock market correction here. Is it right to say a major one?
That'll depend on how active the Fed wants to be in terms of removing the punch bowl, the stimulus that they've been putting into the market. But I think those calls are accurate. Go back to the theme we started earlier in the interview, Daniela. Markets had a huge run. I mean, had a massive run off the COVID lows, had a huge year this year. Again, putting my institutional money manager hat on, you always think about what's next year going to look like versus this year. And if you look at the comparisons in 2021 versus 2020, I mean, the company's earnings this year are comparing to 2020 levels where there was no activity at all. Restaurants were closed, hotels were closed, airplanes weren't flying. So every company's earnings, revenue, margins are going to look really good this year when you compare it to 2020. You look out to next year, you're going to be comparing more apples to apples, where you have activity in 2022 versus activity in 2021. So those growth rates for revenue, earnings, margins are naturally going to decelerate next year versus this year. That's always a headwind for the market. You look at taxes. Likely going up, not down, after several years of kind of lower taxes in the US and Canada. You look at interest rates, likely heading higher, not lower. So the punch bowl, the stimulus from the Federal Reserve, the government spending, a lot of things are going to decelerate in 2022 and again in 2023. So I think it'd be a very rational call to make that things are going to be less exciting in the years to come than they were the last couple of years in terms of stimulus and positives. And the market always trades off the margin. What's the next incremental piece of news? What's the next change? And a lot of those key barometers are going to be going down, not up in the future at the margin. And that should put some significant pressure on the market. The final point will be, what does the Fed do? That's going to have a big influence in the short term, but the longer term, that is the reality. Things are starting to decelerate across the board in the US in terms of the positives that you've seen.
What will the Fed do? I want to take a deep dive there with you. But before we go there, you've been focused particularly on commodities these last few years. You consider yourself a contrarian investor. You entered gold at the end of 2018 when it was not in favor. So what are you liking amidst this environment? Like, would you be out of U.S. equities now, Michael?
Yeah, it's a great question. So I've been a general portfolio manager my whole life. So I'm not one of those perma gold bulls that likes gold in every season, in every situation. I've invested across all sectors in my career. I made a tactical choice to get long gold in 2018 when it's significantly out of favor. I saw a lot of debt in the US. I felt the next recession was going to be really ugly in the US. It would require a massive amount of money printing. I wasn't making a call on COVID. That was unbeknownst to me and all of us, obviously. But the recipe is the same. Every time the US gets in trouble, they print more and more money to get out of the mess they've made over the last 30 to 40 years. So gold thematically was a really good trade for me over a multiple year period, and it was extremely out of favor. As I look at the market today, I wish I could say that I loved more sectors. I wish I could say I was more positive on more corners of the market, but my bullish position on gold is more out of default setting in the sense that most sectors of the market, any asset class you look at, real estate, high yield bonds, equities, most sectors of the market are extremely overvalued, feeding off record low rates. So my capital, I'm really being very defensive with it by putting it in gold where I see undervaluation, lack of involvement from investors, very low valuations, high free cash flow yields. The rest of the market is very vulnerable to me. So I'm kind of sitting out on purpose. But I'd be happy to redeploy if the markets were to correct to levels where I found more attractive, but I don't see a lot of value in markets right now.
Okay, but would you be adding to your gold position now?
Absolutely. I think if you look at the free cash flow yield of the gold producers, you look at the valuation. If you look at the valuation of gold versus the market, so take gold S&P divided by gold, that's at 15-year lows. Gold's never been so cheap versus the market. So gold on an absolute basis versus the market, one unit of the S&P 500 will buy you more gold bullion than it has bought probably 10 or 15 years today. And you look at the equities, the gold equities themselves, they're trading at a huge discount to where they should be based on $1,800 gold. So you have gold is cheap versus the market, and the gold equities are extremely cheap versus the gold price. So I see real compelling fundamental value in the gold sector today. And back to our back to school point, as portfolio managers come back to work in the fall and they look at what's going to perform really well next year, they may start to think about selling some of their high-flying tech stocks or cryptocurrencies or speculative stocks in their portfolio and rotating to what hasn't worked, which is gold that has really good fundamentals and very low valuation. There's not a lot of places you can do that in the market.
The cyber hornets are probably watching this thinking, sell my Bitcoin to buy gold? Are you crazy?
Who would do that?
Who would do that?
Yeah.
Why? Can you talk a little bit more to that? Is that a play you would suggest?
Look, I'm not trying to get cyber attacked on Bitcoin here. I'm not going to make a thesis on the pros and cons of Bitcoin, the usefulness of Bitcoin. All I know is that Bitcoin has a very, very high correlation to the market. So you look at Bitcoin, when the market corrects and the punch bowl's withdrawn or there's a panic in the market, Bitcoin typically sells off aggressively. So I've said this many times publicly before, and I'm happy to say it again. Bitcoin's proof as a store of value will only be proven to me when the market's down 40 to 50%. Call me, let me know what Bitcoin is down, and we'll have a bigger conversation. Because I've seen, my prediction is market's down 40 to 50% at some point in time. Not saying it happens tomorrow. Bitcoin will be down 80%. I mean, Bitcoin, crypto investors are on 5 times leverage. It's the same crowd that are owning stocks that own Bitcoin and cryptocurrencies. When there's a liquidity draw in the market and a panic in the market, everything gets sold. And I think Bitcoin is very vulnerable given it's a crowded trade, given there's a lot of leveraged money and speculation in the sector that'll sell off aggressively. Whereas gold historically in market corrections might be down 5 to 10% and quickly regain its value. That's the real barometer for me, is Bitcoin's going to cross that chasm from being a speculative instrument to a real store of value. Until we get that to that point, I can't make a call on that saying that Bitcoin is a true store of value.
And I've heard that thesis before, when there's going to be a serious market correction, that Bitcoin will correct. The hard part to buy there, though, is the believers, the Bitcoin believers, Michael, will not let go of their Bitcoin.
They won't let go of their Bitcoin intentionally, but when they get a margin call 2 o'clock in the morning and they're levered 5 times and their equities are down 30%, that's what happens in stock market crashes. Most selling is forced selling when it gets to those panic levels of selling. And the leverage, and so whether you believe or not, when TD Ameritrade calls you and says you've got to liquidate your whole account by 4 o'clock or they'll sell it for you, that's the kind of pressure you're going to see on some of those speculative instruments in the market, right? Okay. Whereas the gold investors typically are larger, wealthy, family offices, high net worth individuals that own physical. They're less likely to be called out of their gold than the average investor in Bitcoin today.
Okay, fair enough. And on the gold point, before we move on and talk Fed, from what you're saying, you like the gold miners, ETFs, physical. What's your exposure mix?
I'm invested across the board. So I have some physical gold and silver in my portfolio, maybe 5-10% of my portfolio being physical gold and silver. 30 to 40% invested in kind of small asset producers, companies that have 1 or 2 mines that I think are likely to be taken out or highly likely to be acquired in the next upcycle. And about 30 to 40% in very early stage exploration companies where I'm finding incredible value because of the depressed valuations in the sector and the lack of capital available. You can find some really advanced, valuable projects at 5, 10, $50 million market cap. So I spread my bets across that, but I'm a bottom-up investor. It's all about fundamentals. It's all about the prospects I see for that company. Obviously overlaid with a bullish call on the commodity going forward that the whole sector should do well, but I'm really a single stock picker across all sectors.
Okay, fair enough. And just one last question about the miners. You like the junior space, the mid-tier, the senior, or again, mix?
I like small. Small is beautiful. I've been a 20-year investor in small mid cap. I think you can add a lot more value in the small mid-tier space. There's more room when you make a discovery. If you're Newmont and you make a major new discovery, your stock's up 4% because you're a $50 billion market cap company. If you're a $100 million market cap and you make a brand new discovery, your stock could be up 10 times in a year or less. So I like smaller companies for that torque, for the leverage you can provide. And also you're more likely to find undervalued or misunderstood situations in the smaller sector. There's fewer analysts that follow them, fewer people that invest in them. So you can find hidden gems much more easily in the small space. Now, that being said, it's more risky. It's not for all your viewers. because you have to do a lot more work on the smaller side of things. So it depends on your investment approach, but I think you can find a lot more value in the small mid-size companies.
I like what you said, hidden gems, no pun intended.
No pun intended.
Okay, let's talk the Fed now. I want to pull up a quote where you said either the Fed has to raise rates by 25 basis points next year to regain confidence in the markets, or they let inflation run hot and do nothing. Neither of these scenarios will be enough to contain inflation. You say they need to go to war against inflation. Is this a beast they can't tame?
I think they've ignored the beast for way too long. I made the point in a previous interview I did. If you came down from Mars and you're a Martian, you came down and saw 5.6% unemployment, 6.6% GDP growth, 6 to 7% inflation. And I said to you, the Fed is not only have rates at zero, but are purchasing quantitative easing 120 billion a month of bond purchases. You'd think I'm absolutely insane. So the fact that policy is where it is today, when the economic numbers are where they are today, shows you how unserious or uncredible the Fed is when they talk about trying to tame inflation. So the point I made is if you have 3 or 4 more months of the inflation numbers that we've seen the last 4 or 5 months and they do nothing, the market's going to conclude that the Fed has absolutely zero desire to tackle inflation, and that should set gold off to the races.
Right.
Or they take the step to actually do something and taper or potentially raise rates one day, and the market has a full-on panic attack, heart attack, and the Fed realizes, the market realizes that they're trapped. So either way, you're going to see, I think, a violent reaction in gold once the market realizes that they're kind of boxed in the corner.
Wouldn't you just love to be a fly on the wall in one of those Fed meetings, Michael? Because, the Fed wanted inflation. They needed inflation.
Yeah.
But is it have they lost control here?
You made the point they want inflation. They need inflation. What they really need, Daniela, is negative real interest rates. So if you look at the US, they've got 30 trillion of debt. They took in 3 trillion of revenue as a government in 2019 before the pandemic, and they were spending 4 trillion. So before all hell broke loose with COVID, they were running a $1 trillion a year deficit. Now you have lowered capacity to make money and much higher expenses. So your deficits are going to be structurally higher for longer. The only way to finance that kind of deficit is negative real rates. So negative rates are, pick a number, 4% right now in the US or 3%. That's a free $1 trillion a year carry because your inflation is running hotter than your rates. That allows you to fund systematically $1 trillion or $2 trillion a year of deficits forever. If real rates were to go positive, you'd have a huge fiscal correction in the US coming, both on the government level and the market level. So you're right, they need real negative rates. So if rates are 0, they need inflation to be 5. If rates are 4, they need inflation to be 9. That's the math that they need. This hard math, it's not made up numbers, it's real math to sustain their unsustainable spending, unsustainable debt levels in the US. That's the fly in the wall you're not hearing from them.
Exactly. And just to that point, I want to talk the debt ceiling. I've been bringing this up in other interviews. It's looming in the background. We're not talking about it enough. I know there's been other debt ceilings, but from what I'm hearing this time, it can be different. Do you agree?
I think they'll kick the can down the road again. I think there's enough of a majority in the House, Democrats or left-leaning Republicans that'll allow this to continue. They'll probably take it to the wire. Some of the more moderate Democrats, some of the more stronger Republicans may use that as a bargaining chip to maybe chip away at some of the spendings. But I'd be very surprised if they force themselves slam into the wall like that. Again, given they've had so many opportunities the last 20 years and done nothing about it, I think it'll be more of the same. Just like the Fed's kicking the can down the road, I think the debt ceiling will be kicked down the road again.
I just want to bring up another quote that stood out for me that you've said, Michael. You said, if you take the 30 trillion of debt that the US government has now, assuming rates go to 5%, which is not a crazy number, historically on a 100-year perspective, that would be 1.5 trillion of interest expense, which would be 50% of their revenues, up from 10% of their revenues.
Yep. That shows you how trapped the government is. So when Barack Obama took office, don't quote me on this, but it was around $10 trillion of debt. A short 12 to 13 years later, we have 30 trillion of debt in the US. We've tripled the debt in 12 years. So what that means is you could basically afford a third of the interest expense that you could afford 13 years ago. We could barely afford the interest expense on the debt when Barack Obama was in office. So again, that comes down to my point earlier. They need real negative rates. They need rates to be lower than inflation to sustain this unsustainable level of debt. And the problem with debt, Daniela, is it's fixed. You cannot get rid of it. You can't just wave a magic wand and make it go away. So that the more debt you pile on, the lower the interest rate is that you can afford structurally on your debt in the long term. So that's why the Fed has done nothing while they've seen inflation run hot. That's why they will likely do a lot less or nothing that they have to in the future, because they can't afford the rates to rise. And that's the same. Unfortunately, that's true for Europe. It's true for Canada. It's true for all the major economies. It's true for Japan. It's across the board. this massive debt load that's suppressing rates and suppressing banks' ability to have a normal economy, a normally functioning market as well.
And that's why you want to be in gold.
That's
right?
that's my strong thesis. Correct. Yes.
Okay, but what about silver or platinum, palladium? Anything else in the precious metal space?
Yeah, I mean, silver is poor man's gold. It has more torque. I think if gold really starts to work, you'll see silver work as well. It has industrial uses, which can be positive and negative. You know, there's the EV metals theme there. I still think gold is really the most liquid, most established, the most real currency you have as an alternative to the US dollar and fiat currencies, but silver should work well. Platinum, don't spend too much time on it. It's a bit of a niche market. I don't think it has the liquidity and depth to kind of be a reserve currency or a replacement currency for fiat currencies, but I think gold and silver will do quite well if my thesis comes out to pass.
All right. Well, we will touch base in a few months. Michael, it was an absolute pleasure speaking with you today. I'm happy we met. I'm happy we connected.
My pleasure. Absolutely. We'll talk again soon.
All right. Thank you so much, Michael. And thank you all for watching. We'll have much more for you on stansberryinvestor.com. In the meantime, don't forget to register for premier content at danielacambone.com. That's it for me. Thanks for watching.